So one of the most common mistakes that new options traders make is trading too big. Basically, they take on way too much risk for each trade, and therefore they drastically increase the chance that that risk could get out of control and they might blow up their entire trading account. And so that's why in this video here, I'll be answering the question of how much risk should you be taking on for each trade that you're making, right? Basically, you want to find a balance between taking on enough risk per trade such that you can actually make money in the long term while still withstanding some bad losing streaks and get through some pretty bad volatility in the market, but also not taking on too much risk where again, you run the chance of blowing up your entire account. And believe me, as you'll see in this video, there is a very fine balance in this regard. And so the way I'll be answering this question is by showing you a few demonstrations of the trading simulator that I recently built. So for those of you who are unaware, I also do work a day job as a software engineer. And so I was able to leverage my background and experience in that field to, like I said, build a very realistic option trading simulator. And so in particular, you're going to see how changing the amount of risk that each trade my simulator is going to make is either going to catapult your portfolio into the ground if that risk is too much, or like I said, be just right to allow a portfolio to withstand some pretty bad losing streaks, but still in the long term make a profit. And also one thing to note here, there is a decent amount of explanation I have to do and basically setting the scene, so to speak, before I can show you the actual simulation. So please do bear with me and make sure you watch the whole thing because fully understanding the context around the simulator and understanding how it works is going to be crucial for you to appreciate the final takeaways at the end of the video. Now, as always, before we dive in here, in case you are brand new to the channel, my name is Scott Reese, and I'm here to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And in case you want to see more trading or investing content after watching this video, you can also find me on SKILLSHARE as well, where you can take my very in-depth classes on options trading or stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out. And when you sign up for SKILLSHARE using any of those links, you'll get a full 1-month free trial. Okay, and so with that being said, at this point, we're going to jump on over to my computer here and we'll get things started. Okay, so first off here, before I can show you the actual trade simulator, is I do need to give you some context around the actual simulation in terms of what kinds of trades it's going to be making and basically how everything is going to work. So the setup here is, let's say you are a brand new trader and you have $10,000 of starting capital to begin trading with. Now, that being said, if you are actually a new trader and you don't have $10,000, let's say you only have $5,000 or $2,000, doesn't matter. That's totally fine. Just for the sake of example, for the sake of the simulation, I'm just picking $10,000. So my trading simulator is going to take that starting capital of $10,000 and it's going to sequentially make one after another a bunch of iron condor trades. So of course, with this channel being all about option selling, that's why I chose to simulate an iron condor here, which is an option selling strategy, of course, and it's often a very good choice for a beginner trader. Now, what I'm showing you here in this chart is Snowflake Incorporated. This is basically a pretty new tech company in the cloud computing space, new in terms that its IPO was not too long ago. And so this is the exact kind of stock that my trade simulator is going to use to make all these iron condor trades. And that's because number one here, this stock is reasonably high priced at around $300 per share. So that means if you are going to sell iron condors on a stock like this, you're going to collect a decent amount in premium. And then also, if we come down below and take a look at the implied volatility for Snowflake, the IV for this stock is very, very high right now at just over 86%. And high implied volatility stocks like this are always great candidates for any kind of option selling strategy, because the higher the implied volatility, that means also the higher the option prices will be as well. So high IV plus a high stock price equals a lot of premium that you can collect for any kind of option selling approach. And so now to both show you a brief example of an iron condor in case you need a refresher, and to also demonstrate the exact kind of trade this simulator is going to make, let's now come over to the trade tab for Snowflake and take a look at the option chain here. For this example, let's go into the March expiration cycle with just under 30 days left to go. We'll unfold that tab. And the reason why I chose this expiration is because all the trades that my simulator is going to make are going to be with exactly 30 days until expiration. So with an iron condor, as I explained, this is an option selling strategy, although there are some options that you do purchase as part of this position. But still, the net effect here of putting on an iron condor is you do take in money. You take in a credit. And that's the main characteristic of any kind of options selling strategy. You sell options and take in money as a result. Now, this strategy is also directionally neutral. Ideally, for this kind of position, you want the stock that you're trading it on to simply move around in a nice range. The stock can definitely go up a little bit, it can go down a little bit, but you don't want it to go too far in either direction. And in terms of the structure for the Iron Condor, it's basically a combination of selling both an out-of-the-money call credit spread and also an out-of-the-money put credit spread. And ideally, you want the stock to remain in between the short call strike and the short put strike of those two spreads. So for example here, coming back to the option chain for Snowflake, taking a look at the call options here first, if I wanted to sell an Iron Condor on this stock, for my short call strike, I would probably choose this one right here. This is the 330 strike. And then I would probably purchase the 340 strike call option. So therefore, with my short strike at 330 and the long strike at 340, this would be a $10 wide call credit spread, which again makes up the first half or the first piece of the full Iron Condor. And so then in terms of the put side here, for my short put strike, I would probably choose something right here at the 205 strike. And then same thing with the call side, I would also choose my long put option, specifically choose the strike of the long option to be $10 away from my short strike. So that's why I would also purchase the 195 strike put option. And so with that being said, with my strikes being picked now, I can go ahead and right click on this option and go ahead and set up the order. So I go to sell and then come down here and click Iron Condor. And here we go. Down below is the order. Going to sell one contract of the 330 strike call option. And then alongside that, also going to purchase the 340 strike call option. And then for the put side, going to sell one contract of the 205 strike put option. And then also purchase one contract of the 195 strike put option. So basically, I would be trading 4 contracts here at the same time. And for putting on this entire position, by trading all these contracts, the net effect here is, like I explained, I take in an overall credit. I take in money that amounts to $285. So that's why this strategy here is still considered an option selling strategy. And like I explained, for this kind of position, I want the stock to remain within a range. Specifically, I want it to be within my 2 short strikes. So essentially, by the expiration date, I want Snowflake to be under $330 per share. This is my short call strike, right? And also above $205 per share. This is my short put strike. So anywhere within this range here by the expiration date, that's what I want. And in that case, if that happens, I'll get to walk away and keep the full $285 in premium. And then the way I would lose money on this position is if by the expiration date, the stock was well beyond either one of my short strikes here. And the further the stock goes beyond 330 or below 205, the more money I would lose until I hit the max loss situation. And the way you calculate the max loss of an Iron Condor is you simply take the width of either the call credit spread side of the Iron Condor or the put credit spread side, actually whichever spread is largest, but in this case, in this example, they're both $10 wide. So take the width of the spread and subtract from it the credit you receive for putting on the position, and then multiply the result by 100. So in the case with this Iron Condor here, let's go ahead and pull up the calculator real quick. The width of my spreads here, as I explained, are $10 wide each. So that means we just take 10 and subtract from that the credit I received for the entire position, which is $2.85 on a per share basis. So we subtract 285, and that gives the result of 715. And then finally, we multiply this by 100. So that means for this exact Iron Condor, the maximum loss is $715 and the maximum profit is $285. And again, this number here is quoted on a per share basis. That's why it says $2.85. But because options are tied to 100 shares per contract, that's why you multiply everything by 100. Now, finally here with this trade, take note of one more important thing. Specifically this column here, this is the probability that all these contracts will expire in the money. So for the 330 strike call option here, this is the one I'm selling, the chance that by the expiration date, this option becomes in the money, or essentially the chance that Snow moves all the way to and above $330 per share by March 18th, is only about 17%. And very similar with this 205 strike put option, this is my short put, right? The chance that this option will expire in the money, or the chance that Snow will fall in price down to and below $205 per share, is also just below 17%. And I picked these two option contracts for a very specific reason. And that's because with an iron condor strategy, where in particular the options you're selling have about a 16 to 17% chance of expiring in the money, that means the range in between your two short strikes, in between your short call and your short put strikes, this range here is referred to as a 1 standard deviation range, which means there's about a 68% chance that by the expiration date, SNO stock will be anywhere within this range, anywhere above $205 per share and below $330 per share, right? And that's because if I pull up the calculator one last time here, if there's a 16.86% chance that SNO could be below 205 by March 18th, and there's also a 17.02% chance it could be above $330 per share, that means I can take 16.86 and add to that 17.02, and that gives me 33.88. So now this means there's about a 33.88% chance that by the expiration date, SNO stock will be beyond this range here. And therefore, finally, if we take the inverse of this probability by subtracting it from 100, so 100 minus 33.88 equals 66.12. And that means there's a 66% chance that SNO by the expiration date will stay somewhere in between this range. And like I said, this is very close to 68%, which is also referred to as 1 standard deviation. Okay, so now with all that being said, I'm now going to sum all this up into the exact criteria that my trading simulator is going to use to make all these iron condor trades. So again, we're going to start out with $10,000 of initial capital, and my trading simulator is going to simulate making 500 sequential iron condor trades, just one after another. And each trade is going to be on the same stock that's going to start at a price of $300 per share, which again is very similar to Snowflake. And for this made-up stock that my simulator is going to use, we're also going to assume that the implied volatility for this stock is just going to be a constant 50%. So unfortunately here, because I do not actually have historical option pricing data, that's why my simulator here is going to be using theoretical values to simulate these trades. And as a result, I do need to make a few basic assumptions. And so based on that implied volatility, which is pretty realistic for most stocks, my simulator is going to use that implied volatility to calculate the 1 standard deviation price range. So again, coming back here real quick, these percentages, these probabilities of these options expiring in the money, these are calculated from the implied volatility of the stock, in this case of Snowflake. And so like I already explained, the 1 standard deviation price range for this stock by the March 18th expiration date is anywhere above $205 per share and below $330 per share. This is the 1 SD range. So again, my simulator is going to use that 50% implied volatility, and based on that number, it's going to calculate what that 1 standard deviation price range is going to be for the expiration date in 30 days. And based on that range, that's how my simulator is going to choose the strikes for the iron condor. Specifically, the short strikes, the short call, and the short put are going to be selected right on or very close to the ends of that 1 standard deviation range, right? In exactly the same way I've done here with Snowflake. For my short call strike, I chose 330 at the very, very upper end of the 1 SD range. And then for the short put strike, I chose the 205 strike at the very lower end of the range. And then the spread width of the two sides of the iron condor, which dictates the strikes of the options I would purchase, that's going to be the main variable in my simulation, right? In particular, you're going to see how changing the spread width on the iron condor in the simulation, and therefore increasing or decreasing the amount of risk per trade. You're going to see how varying that amount of risk is either going to send your portfolio on a nosedive into the ground and basically blow the whole thing up, or allow your portfolio to still withstand some pretty bad losing streaks and over time still make money. So in some simulations, I might set the spread width to be only $5 wide. In other simulations, I might set it to be $10 wide or $20 wide, etc. And again, you're going to see the effect of changing that risk. Now, as I mentioned, because I do not have actual historical data for option prices, I do have to create some theoretical pricing for the options that my simulator is going to use. So therefore, once my simulator has picked the strikes for the iron condor trade it's going to simulate, it's going to use the Black-Scholes option pricing model to calculate the theoretical prices for all those contracts. So in case you're curious, if I come over here real quick, these are the Black-Scholes equations, right? So you can basically calculate the theoretical value for either a call option or a put option based on certain inputs like the current stock price, the current implied volatility, how much time left until expiration, interest rates, etc., etc. You basically plug all those values into these equations, and then you'll get, like I said, the theoretical value for that corresponding call option or put option. And definitely don't worry about all this math here. It's by no means required to understand it. Just understand that my simulator is going to use all this math here to, of course, figure out the prices of the options it's going to trade. And then from that, figure out how much premium it's going to collect on any given trade, and also how much risk, the max loss, basically, also exists with that position. And then finally, in order to simulate where the stock price is going to be by the expiration date, and of course, based on that, that's going to dictate whether the Iron Condor was profitable or not profitable, right? So in order to realistically simulate where the stock price is going to be, that's going to be chosen at random, but it's going to be based on the normal distribution curve. And as I've explained in previous videos, daily stock price fluctuations very closely follow the normal distribution curve. Now again, here, same thing with the Black-Scholes equations. I don't want to get too in depth into what this is or how it works, right? You could definitely take an entire course on just what the normal distribution curve is and how to apply it, but I will say this. Using this model to simulate where the stock price is going to be by the expiration date means, in most cases, for most of these trades here, the stock price by the expiration date is going to be somewhere in the general vicinity, somewhere in the ballpark of the stock price when you first put on the position. So for example, in this case here, if SNO right now is at about $275 per share, then in 27 days by the March expiration date, this stock is most likely going to be somewhere around this price. Perhaps by March 18th, it might be at $310 per share or $262 per share. Again, it's going to be somewhere in the ballpark of the starting stock price when you first put on the position. But of course, also in more rare situations, the stock can definitely move by a huge amount by the expiration date. And again, using the bell curve to simulate where the stock price is going to be by the expiration date allows me to accommodate that kind of rare circumstance. So basically, every now and then while my simulator is making these trades, sometimes the stock is going to move by a huge amount. And that's going to mean for a max loss situation on the Iron Condor. And finally, the last detail I need to mention here about the simulator is that it's going to make 500 of these Iron Condor trades in a row, and those 500 trades are going to be one trial, or basically one portfolio. Then after that point, it's going to do the whole thing all over again. Basically do a second trial, start with a brand new second portfolio, $10,000 starting capital, and then make 500 more Iron Condor trades all over again. And it's going to keep doing this until it completes 10 total trials. So basically, it's going to simulate 10 portfolios, all starting with $10,000 of capital, and each portfolio is going to go through 500 Iron Condor trades. And the reason why I'm doing multiple trials is because I want to show you the average performance or the average outcome amongst a variety of simulated traders, right? Because one trader or one portfolio might just be super unlucky and hit a bunch of losing trades in a row and blow up the entire account very, very quickly. Or conversely, a different portfolio might be super lucky and just hit a bunch of winning trades and double the entire account. So just showing one sequence of 500 trades, one portfolio basically, is not going to give you the full picture. And so now at this point, and I do know there's a lot of setup getting here, so I thank you for your patience, but now we are finally ready to go over to my trading simulator and show you the results. Okay, here we are. This is my trading simulator that I wrote pretty recently. It's basically a Python application that is pretty short, but of course is a bit complex as well because of all the mathematics that's going to be applied in the simulation. Now, if I come up here and click on this button and then go to Edit Configurations, I can configure, of course, the exact settings of my simulator. So in particular, I want to draw your attention to this line right here. So like I explained, the starting amount of capital we're going to deal with is $10,000. And then with the next setting here, this is how I specify the width of the spreads for the Iron Condor. So right now I have things set where every Iron Condor that's going to be simulated, the difference in the short and long strikes of both the call side and put side of the Iron Condor is going to be $20 wide. So this here is a very wide Iron Condor for only a $10,000 account. And that's because, if I bring back the calculator here real quick, let's say for a $20 wide Iron Condor, I collect maybe $5 in premium on a per share basis. So that means taking the difference between the spread width and the premium I collected and then multiplying by 100. Again, this gives me the maximum loss on the Iron Condor. It's going to be $1,500, which if we divide by $10,000 of starting capital, that's 15% of your account. And so as you're going to see here, this is actually way too much risk for your portfolio with only $10,000 to handle. And therefore, over the long term, over the course of these 500 trades, you're going to see a lot of these portfolios go to zero very quickly. So then coming back here, as you can see with my next setting, I have for the number of trades, 500, as I've explained, and we're going to do 10 total trials. 10 portfolios, all starting with $10,000, making 500 trades each. So with those settings in place, I'll click OK, and then now finally go up here and click the play button and run the simulation. And here we go. This is the output of the simulation. It basically shows you a graph or a series of graphs, each of which corresponds to a certain trial. And so essentially it's showing you a time series of each trial, and in particular how the account value of each portfolio fluctuated across all those 500 trades. So for example, let's take a look at this one right here in orange. Looks like this one corresponds to the second trial that was simulated. And then as you can see, like I explained, every portfolio begins with a starting capital amount of $10,000. And then in the case of trial number 2 here, unfortunately, this portfolio did not even make it through 100 trades before the account hit $0. So this one here definitely hit a lot of bad luck right out the gate, had a lot of losing trades in a row. And because the risk on those Iron Condors was so great, with them being $20 wide spreads, it was simply impossible for this portfolio to ever recover. So it went straight into the ground. And then take a look at this one over here. This is trial number 3. This portfolio survived a bit longer. It made it past 100 trades, but it also went straight to zero. The entire account got blown up. Same thing with this one. Portfolio number 5 also went to zero. Trial number 10 also went to zero, and so on and so forth. So from the simulation, it seems that 7 portfolios completely blew up. They all went to zero. And then 2 portfolios lost about half of their account value right after 500 trades. Trials number 1 and 8, it looks like, ended up with exactly around $5,000 of capital left. So again, that's a loss of 50%. And then only one portfolio, only one trial, looks like number 9, actually was lucky enough to make money. In particular, this one here, if I come back to the y-axis, after 500 trades, portfolio number 9 made about $17,000. Really, really good. But obviously, as you can see here, the odds are overwhelmingly in favor of you blowing up your account if your trade size is too large. And this really is the number one mistake that I see new traders making. When you trade too big, eventually you will run into some bad luck and hit a losing streak. And in that case, chances are your portfolio is not going to be able to recover. Right? Basically, the losses are just going to be too large to overcome, and your account is eventually going to crash into the ground. And again, this stuff here is applicable to any kind of option trading strategy, option buying strategies, option selling strategies, not just Iron Condors. Trading too big with any kind of strategy and with any kind of financial product, not just options, will inevitably lead to disaster. And so finally in this video, let me go ahead and exit this one out. Let me now go back to this button here and edit my configurations. Now let's change the spread width to only $5 wide Iron Condors. So now in this case, bringing back the calculator one last time, if on a $5 wide Iron Condor, let's say I collect maybe $150 in premium, or on a per share basis, that would be $1.50. So I subtract 1.5 from 5, and then if I multiply that by 100, that means the maximum loss on a $5 wide Iron Condor, where I'm collecting $150 in premium, the max loss is $350, which if I divide this by the starting capital amount of $10,000, that means the max risk on this trade here is only 3.5% of the total account value. And this is much, much more in line of where it should be. Not 15% as you saw with the previous simulation, right? Risking that much on a trade, you have a very high chance of blowing up your account. But in this case, if you only risk maybe 3.5% or somewhere around here, as you're going to see, you have a much, much stronger chance of actually making money over the long term. So with that said, go ahead and apply and click OK with those new configurations. And now we'll go ahead and run the simulation one last time here. And there we are. Let me go ahead and expand this out a bit so it's easier to see. So now with this simulation, we have a much more even distribution of the outcomes of all 10 trials. Again, each one starts with a capital amount of $10,000. And over the course of making 500 trades, about half of them either broke even or made money, and the other half lost money. And also take note, not a single portfolio went to zero. Right at the end of these 500 trades for these two trials, numbers 2 and number 8, obviously the outcome here is not good, but the capital left over is still above 2,500. So those two portfolios still lost almost 50% of the capital, but that's certainly much, much better than losing all your capital. And the full outcome of the simulation here is exactly what is to be expected, specifically when the risk is kept in check, right? And that's because trading is all about playing probabilities. And like I showed you with these iron condors, every trade has about a 70% chance or so, a little bit less, of making a full profit on the position. So of course, with that in mind, some portfolios are going to be a bit more lucky than others. They're going to have more winning trades than usual. And that's why over the long term, they actually made a decent amount of money. Look at number trial 9, for example. This one here made about $7,500. So you're always going to have a few outliers to the upside and a few outliers to the downside. And then the majority of outcomes are going to be right around unchanged. Or I should say right around the average starting value, which was exactly $10,000. So the main takeaway from this video is you must keep your risk small enough such that you can withstand some pretty bad losing streaks and weather some tough storms. So that way you have the chance to recover and still make money over the long term. Right, in the case of trial number 9 here, for example, this is the one that did the best over the simulation. There were definitely a lot of times along the way here where this portfolio lost a decent amount of money. But because the risk was always small enough compared to the account size, that meant a recovery was always still possible. So in conclusion here, no matter what kind of strategy that you're using, do always try and keep your risk per trade under 10% of your total account size. And when I say 10%, I mean 10% as an absolute maximum. Ideally, if you can keep it under 5%, that's where you really should be. And then also on top of that, I would not allocate more than 60% of your total account value across all the trades that you have on right now. Right? You always want to have some spare cash on the sidelines that you can use to endure and get through a bad losing streak. And so with that being said, that's going to do it for this video. I hope you enjoyed it, and please let me know your thoughts or if you have questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading or stock market investing, then check out my SKILLSHARE courses. Links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.